Thank you so much for your interest in the BlackRock Sustainable American Income Trust. I do think this is a really unique product. We're positioned at the intersection of both value and sustainability within the North American market. And we do think both of these factors are poised for a comeback. You can flip to the next slide. So this is an overview of the trust structure. We made substantial enhancements in July of 2021. But before I go into the changes that we made, I want to talk about what hasn't changed. So first of all, the trust sits within the broader income and value team here at BlackRock. We manage about $60 billion in assets across several strategies, and we are supported by 20 research analysts. So we're a very well-resourced team. The portfolio managers are myself, Tony DeSpirito, and David Zhao. We've worked together for a number of years, and Tony DeSpirito, in addition to wearing his portfolio manager hat, is also the Chief Investment Officer of the fundamental equities business here at BlackRock. We've also maintained our focus on the dynamic US market, and we've maintained a value investment style that focuses on dividend-paying companies. Now, what has changed? So we've implemented a dual mandate for both capital appreciation and superior sustainability outcomes. And when we talk about sustainability outcomes, we are referring to two key metrics, a premium ESG score on the overall portfolio and lower carbon emissions intensity versus our benchmark, which is the Russell 1000 value. In addition, we've also broadened the investment universe that really allows us to fish in a bigger pond. So we've gone from large cap to multi-cap. We've also reduced the number of stocks within the portfolio, so it allows us to own our highest conviction names. And lastly, we've allowed the trust to take on leverage if we see fit, depending on the macro environment. Next slide, please. This slide goes into a bit more detail on our investment philosophy. So as I mentioned, the fund has a dual objective of delivering alpha and superior ESG outcomes. And we think the best way to do this is through deep fundamental research and ESG analysis. So our goal here is to build a high conviction portfolio of attractively priced, high quality, dividend paying US stocks. On the ESG side, we think about the portfolio and we divide the portfolio into three different groups. We have ESG leaders, ESG improvers, and ESG enablers. The first group, ESG leaders, that's pretty intuitive. These are companies with the best ESG profiles within their sectors. And the majority of our portfolio is invested in ESG leaders. The second group are what we call ESG improvers. These are companies that currently have below average ESG profiles, but where we think there's opportunity for improvement. This is often where we find interesting underappreciated opportunities. A past example that we invested in was a traditional US auto manufacturer, where for a very long time, the opportunity in electric vehicles was undervalued. And then the last grouping and the smallest group are what we call ESG enablers. These are companies that are directly enabling the transition to net zero. Next slide, please. The sustainability characteristics of this portfolio are measured in a few ways. First and foremost, the portfolio has a premium aggregate ESG score, and that's measured by MSCI, in addition to having superior individual E, S, and G scores. Our current portfolio has a 15% premium ESG score relative to the Russell 1000 value. Second, there are certain ESG exclusions, including sectors such as tobacco, controversial weapons, coal companies, etc. Third, our climate objectives include lower carbon emissions intensity versus our benchmark and higher exposure to companies committed to SBTI. Now, SBTI, for those who are not aware, is a nonprofit organization that companies can commit to, and then SBTI will evaluate that company's climate plan to see if it's aligned with net zero goals. Our portfolio currently sits at 60% lower carbon emissions intensity versus the Russell 1000 value. And then lastly, we also engage with companies, especially those who have below average ESG characteristics. And the goal of these engagements is really to better understand how companies are progressing against their ESG targets. Next slide, please. Great. This is what the portfolio looks like from a very high level. So the notable sector overweights are healthcare, consumer discretionary, and technology. Healthcare is a sector we like a lot. I have a slide on the sector later, but we like the healthy level of growth, the defensive characteristics, and the reasonable valuations here. Consumer discretionary, our holdings here are more concentrated in autos and certain idiosyncratic ideas that we have. And then we also like the tech sector. These companies tend to have strong balance sheets. They generate high returns on capital. And we've observed that they have staples-like qualities and that they sell products and services that are hard to stop buying even in downturns. Now, on the other side, our notable underweights are industrials, REITs, and utilities. We think industrials trade at high valuation multiples and they're very economically sensitive, and we believe that we are currently late cycle. Utilities and REITs don't perform well in the rising rate environment, and that's why we're underweight those two sectors. On the bottom right, you can see broad portfolio characteristics. You can see that the trust trades at a lower price to earnings multiple than the benchmark while offering a higher dividend yield and higher dividend growth rate. Next slide, please. Great. This is the last slide on the trust before I move to our views on the market. So this is the slide on performance. Now, I do want to remind everyone that the new mandate for this fund started in July 2021. So the longer dated historical performance is not informative of what the current strategy should deliver. Now, looking at the shorter term performance since the strategy change, we acknowledge that we've underperformed the benchmark and we are not happy with that performance, but we can attribute that underperformance to a few discrete factors. So the first factor is that while ESG funds initially outperformed, if we look over the last 2 years, they have underperformed over that time frame. We don't think that is a dynamic that will necessarily persist in the future. It just so happens that it has occurred in the last 2 years. When we compare the trust to other ESG funds, we have actually outperformed. The second discrete factor that has driven the underperformance has been one single stock, and that has been Meta or Facebook. Facebook has been a very strong performer in the last year. Unfortunately, this stock does not fit within this strategy, and there are 2 reasons for that. First, Meta has a very poor ESG score. They are rated CCC, and that's because they operate a social media network. So there are structural reasons for why it does not score well. Secondly, Meta does not pay a dividend, so it does not fit our income requirement for this fund. Now, these 2 factors have had a substantial hit to our performance over the last 2 years, but we don't think that these factors will persist into the future. Great. So those are the slides on the trust. Now I'll talk a bit about the market. We can move to the next slide, please. So while we are bottoms-up stock pickers, we are aware of where we are in the economic cycle, and we are taking a cautious view in the portfolio. If we look at some of the macro headlines, right? So inflation is softening, but the fact of the matter is that it is still very high. We've just gone through and are still going through one of the fastest tightening cycles that we have seen since the Great Inflation. And we think that the odds of a recession remain elevated, even though the consensus seems to be that we will navigate a soft landing. We are not in that camp. We still think a recession is our base case. And the reason why we still believe that is that recessions do take time to play out. Interest rate rises take time to permeate the market. Now, where do we see opportunities, right? So we think the S&P 500 has gotten very expensive. I have a slide on that a little later. We do see a lot of value in the Russell 1000 value, which is trading at a very steep discount to the S&P 500. And then within our universe, we also see opportunities within quality stocks, within the international market, and also within healthcare. So I'll run through those in the coming slides as well. Next, please. Great. So this slide looks at the PE multiple of the S&P 500. That's the top chart in green. And you can see that the multiple on the S&P is about 1 standard deviation above the average over the last 50 years. So it's in the expensive territory. And then the bottom chart shows the discount that the Russell 1000 value is trading at versus the S&P 500. And what's notable here is we are trading at one of the largest discounts we've seen over the last 10 years. And in the past, for example, at the end of 2021, when we saw such a large discount, we did see that discount narrow in the following year. So we're quite optimistic about the performance of value going forward. Next slide, please. This chart shows the probability of a recession as implied by the shape of the yield curve. And we have the prior recessions in the gray bars. And what's notable is that in the past, when you've had the orange line spike as much as it already has, you've had a recession coincident with that rise or soon after. And so we continue to lean conservatively within our portfolio because we do think a recession is coming and we don't think that it is priced into the market. Next slide, please. The left side shows core inflation, and we can see that while core inflation has come down from the highs of 2022 at 4.6%, it's still much higher than where we were between 2010 and 2020. The chart on the right shows the unemployment rate, and you can see that the unemployment rate is still very low. So the labor market remains tight, and we do think that will continue to put upward pressure on inflation and make the Fed's job of tamping inflation hard. Next slide. The top chart shows a money supply year-over-year change. You can see we entered negative territory at the end of 2021. So money supply is being drained in the US. The bottom chart shows the Fed funds rate, and you can see we've had a very sharp increase in the Fed funds rate over the last year. So financial conditions remain very tight. And that's one of the reasons why we are cautious on this economic cycle. Next slide, please. We are specifically concerned about earnings. So here we've looked at all the US recessions since 1957. There have been 10 recessions, and on average, earnings have declined about 13% from peak to trough, or 18% in the last 5 recessions. This contrasts very sharply with where current estimates sit. So current consensus estimates have S&P earnings growing 12% in 2024. So we do see downside risks to S&P earnings next year. Next slide. The left-hand chart shows where we see opportunities, right? So if you look at the left, this shows the performance after recessions for growth stocks, the broader Russell 1000 index, and value stocks. And what's notable here is that value stocks outperform both growth and the broader market coming out of recessions. And so I think one of the key messages is that it's although we are working with recession as our base case, it is extremely hard to time when it starts and when it stops. And so our advice is to remain invested, and we see value as a great place to be within the market, given that it does tend to outperform coming out of recessions. We also really like quality stocks. So that's on the right-hand side. We show the average returns following Fed rate hike cycles for quality stocks, all equities and bonds. And you can see quality stocks outperform both equities and bonds over multiple time horizons after Fed hiking cycles. And so we have been shifting the portfolio towards higher quality stocks in anticipation of the Fed raising rates. Next slide, please. We think that valuation spreads, being as wide as they are, does create an opportunity for us. So this looks at the cheapest stocks relative multiple to the US average, and you can see that the cheapest stocks are trading 2 standard deviations below normal. So we see a lot of opportunities for us to pick amongst that lowest quintile of cheap stocks to put into our portfolio. Next slide. So this looks at a similar metric, but for quality stocks. So quality stocks, although they have re-rated since the lows of 2022, they are still trading below their average valuation multiples. And that's why we think this group of stocks is particularly interesting. Next slide, please. I mentioned earlier that healthcare is one of our sector overweights. We think this is a very interesting sector. It has good growth characteristics, and that's driven by an aging global population. It also scores well on stability. So if you look at the right-hand side, what's surprising is that earnings for the healthcare sector are more resilient in downturns than even traditional defensive sectors that we tend to think of, such as staples and utilities. What's doubly interesting is that valuations are modest. So on the left-hand side, you can see that healthcare trades at a discount to the S&P 500, and it's cheaper than staples, and it trades on par with utilities, but has much better fundamental characteristics. Next slide, please. Another area where we're finding opportunities is in the global market. As I mentioned in the beginning, this trust is focused on the North American market, but we do have the ability to own international stocks when we see mispricing. And we see mispricing in some sectors. On the left-hand side, this is looking at free cash flow yield of global oil and gas companies versus the free cash flow yield of US oil and gas companies. And what's striking about this chart is that global oil and gas companies are trading at 2x the free cash flow yield. So they are half as cheap as the US equivalent companies. So we think that's really interesting, and we're taking advantage of what we view as a mispricing there. The chart on the right shows the same metric, but for the personal care and household product sector. So the arbitrage here is not as large, but it is still quite significant. Next slide, please. Okay, this is the last slide for me before we move to Q&A. The one final area where we're seeing international versus US mispricing is within pharma. And the left-hand chart shows that the growth runway for European pharma majors is still substantial. You can see that patent expirations, bottom left chart, is pretty minimal for European pharma companies. On the other hand, for US majors, patent expirations are pretty astronomical over the next few years, and that's why revenues are expected to be fairly flat for the US pharma companies. And the mispricing here is that European pharma companies actually trade at a discount to US pharma companies despite these divergent revenue paths. So we think this is also another interesting opportunity within the US versus international mispricing. So I will end it there. I'm happy to answer questions. Again, to reiterate, we want to acknowledge that we've had a challenging start to the new strategy, but we still believe that we can deliver on the dual objectives of capital appreciation and superior ESG outcomes. And we think the time is ripe for both value and quality to make a comeback. And we think that the BlackRock Sustainable American Income Trust is uniquely positioned to capture that opportunity. So I'll end it there and happy to answer any questions that people have.
Thank you, Lisa. Just a quick reminder to everybody, do type away with any questions you may have for Lisa. You don't need to be polite or wait until somebody else has typed anything. Does one question here for Stephen, quick one. It's the North American Trust. Does that include Canadian stocks in your universe?
Yeah, so right, so that does include Canadian stocks. So maybe I should talk a bit about how our research team is structured. So we have 20 research analysts who are sector experts on their coverage, and we cover companies in North America, so US, Canada, and Europe. And so we really leverage all the ideas that each of those analysts generate to kind of form a best ideas portfolio for the BlackRock Sustainable American Income Trust.
Okay, thank you. Just as a matter of interest, in terms of the criterion you apply, there's quite a layering of criteria there that any company has to meet in order for you to consider it investable. So, if what kind of percentage of the market in North America would you regard as investable? In other words, that they sufficiently meet your quite strict criteria.
Yeah, so the majority of the universe is still investable. So Charlie, correct me if I'm wrong, but I think when we did the analysis, about 93% of the universe was still within the investable universe after we've screened the universe for the ESG criteria that we have.
Yeah, that's correct. It sort of so far it's sort of fluctuated between about 6 or 8%, which is uninvestable. That's versus the Russell 1000 value index.
Oh wow. Okay. I'm surprised. Yeah, that surprised me because thinking about the criteria you're applying there in terms of they have to be a certain level above the average for some of their ESG criteria. By definition, if they're that far above the average, I kind of get the feeling there's a hell of a lot below that line that you would not be able to invest in.
I see a question. Is that 93% by market cap? No, it's 93% by number of names. And
No,
then
yeah,
there's
number of companies. Yeah.
yeah,
Okay.
number of companies. That's correct.
Well,
There's a question. Oh, sorry.
sorry, go on. Sorry, Lisa. Yeah, so that would 93% of all companies on the market would actually meet your ESG criteria and other criteria, financial criteria that you would have.
Right.
Are you being picky enough, you might ask?
Yeah, I mean, so that's the investable universe. Obviously, we have a combination of quant screens that we use, and then obviously our sector experts that filter through that universe of stocks and really come up with
Sure.
what we view as the best ideas for the portfolio.
Right. Okay. Yeah, that's interesting. I was interested, the other bit I was just looking at as well, you were interestingly, your yield on the portfolio is higher than the average for the peer group. Again, I always associate ESG companies with probably the ones that are putting more investment onto the ground to improve their ESG performance, and are therefore probably going to be paying slightly less in terms of yield. But you seem to be suggesting the opposite. In your experience, if you're looking at a particular sector and the peer group within that sector, is it typical that the better ESG performing peers would be actually performing better in terms of yield as well?
So I think if you look by sector, that's not necessarily the case. I think what you are speaking to, I think does make sense in that a lot of sustainability and ESG strategies do have a tilt to growth factor because technology companies tend to screen well on ESG. Tech companies tend not to pay a dividend because they are, as you mentioned, reinvesting a lot into the business. I do think what's unique about this strategy is we're combining kind of a value discipline with sustainability, and overlaying, a healthy level of income, which is not something that you can readily find in the market, to have all kind of the intersection of all three of those traits, which is what I think does make this trust unique.
And just to sorry, just to jump in there, Lisa, on the yield of the trust, which is as at the end of August was 4.4% yield, and that is based on 4 quarterly dividends of 2 pence per share. So that's actually an enhanced yield currently set by the board that is paid out, and any shortfall of income earned through the portfolio is then topped up with a payment out of a distribution from capital reserves, distributable reserves from the trust. So that's what's bringing the portfolio yield, the trust yield, up to 4.4%.
Right. Okay. Thank you. But do you what's your policy on dividends?
So the current policy is to pay 4 quarterly payments of 2 pence per share, and any shortfall of income earned will be topped up by distributable reserves to make sure that those 4 quarterly payments can be met, and at 8 pence per share over the course of the year, that currently works out at a 4.4% yield. So it's a fixed dividend distribution currently, as opposed to a fixed percentage yield.
Right. Okay. So so you take that on an annual basis, but presumably you're looking to progress over the cycle with that, through the cycle, without any reductions. Is that
Yeah, so the ambition is to maintain that dividend distribution. The underlying income from the portfolio will fluctuate. So the top up from distributable reserves will vary depending on how much income is earned through the year.
Yeah. Okay, thank you. We have another question from Stephen here. Small and mid caps are at huge valuation discounts, yet you are still focusing on large and mega caps? Suggestion maybe that you should be moving down the market in size slightly. Any comments on that, Lisa?
Yeah, so as I mentioned, the BlackRock Sustainable American Income Trust sits within the broader Income and Value platform. The Income and Value platform manages several different strategies. So we have large cap strategies. We also have mid cap strategies. And so our analysts are looking at ideas across the market cap spectrum. And then the second point is that we did change the mandate of the trust to allow us to go down in capitalization. So it used to be a large cap focused trust. Now we have expanded it to multi-cap. So it does allow us the flexibility to go down in market capitalization. We have looked at small cap and mid cap companies. For small cap companies, I will say that we are having a hard time finding interesting opportunities in this market. If you look over the last decade, the quality characteristics of what's in the small cap index has deteriorated. So these are worse companies than they used to be. And a lot of times they are value traps. So we've kind of ruled out a lot of the ideas in that market just as poor fits for this portfolio. And we do own a sizable number of mid-cap stocks within this portfolio.
Okay, thank you. Another one from Stephen. Stephen's asking all the questions here. So, oh, good. We've got another one from somebody else coming up. That's nice to see. Stephen, could you give examples of enablers, please? You didn't see any in the top 10 that you listed.
Yeah, so enablers are, as I mentioned, kind of the smallest grouping within our three different ESG buckets. But some examples of enablers include Pentair, which is a pool filter and water filter company that drives greater energy efficiency. And then I think we own several of the US healthcare insurers, and these companies are also what we would deem to be ESG enablers in that they are enabling and granting people access to healthcare across the United States.
Okay, thank you. What is your present gearing, given your relative caution about the market?
Yeah, so we're currently at 0, so we have not levered up the portfolio, but just given that we are cautious on the economic outlook, but we like the flexibility to take gearing up when we do feel more favorable about kind of the economic environment or where valuations sit.
All right. What does your mandate allow you to go to in terms of gearing?
Up to 10%.
Okay, thank you. Another one from Stephen. How big is the revenue reserve in terms of years of dividends?
Yeah, I'll take that one. And I thought this was coming up. I was just messaging our fund accountant, and so a couple of years back, the board converted our premium account into a distributable reserve, and so in effect, we've got a large proportion of the assets can be distributed via as a dividend. The exact number I don't have to hand, but the ballpark figure was 30 or 40 years worth of dividend if it sort of gets that sort of stage. But in essence, the trust has the ability to pay out of capital reserves now. So really, what this trust is offering is a total return kind of approach to investing, and part of that is paid out through an income distribution, and obviously with capital return as well, capital appreciation, that will kind of maintain and still help the trust grow over the longer term.
Right, thank you. What is the board's share buyback policy for the trust?
And so each year the board take shareholder authority to be able to buy back up to 14.99% of the shares in issuance, depending on prevailing market conditions. Currently, the discount on the trust is between circa 7 and 8%, which is and that's without any sort of buybacks taking place, a kind of natural discount in the market, which is the narrowest of the peer group, other than one of our peers, which I know have been pursued.
Well, I've lost
There's
Charles.
lots of
Charles, I think I lost you there. I don't know whether the rest of the audience did. There was a 2 or 3 second glitch. Perhaps you could just repeat the last
you still
sentence.
Got me?
I've got you now. Yes.
Oh,
could you try that one again?
I was saying that the current discount at 7.5% is one of the narrowest in the peer group. There is one which is narrower, which has been pursuing a sort of active buyback policy. Given the size of our trust, there's a limit to sort of how much buyback the trust could afford to do anyway. But given that we're also within the tightest of the peer group range, the board haven't sort of felt it necessary to step into the market and buy back shares. I would say that the current discounts in the industry, the average is at circa 16%. So there is a sort of industry-wide phenomenon of very wide discounts given the current market malaise and sentiment. So where the trust is naturally sitting at the moment is relatively strong versus its peers, but clearly we want to move back into more favourable conditions and close that discount.
Okay, thank you. Bill Faulkner wants to ask, how small are the small caps in the portfolio at the moment?
Yeah, so as I mentioned earlier, in our work on the small cap space, we really haven't found companies that we think are a good fit for the portfolio, just given a lot of the structural issues that the smaller companies do face. So we don't own small cap names at the moment, but we as a team are constantly looking at ideas across the market cap spectrum. And so when we do find ideas, they will compete against other ideas, but they will make their way into the portfolio as we kind of find interesting opportunities.
Okay, thank you. Just as a matter of interest on following your ESG policy and so on, do you find it makes a particular difference to the cost of research and management these days compared to a non-ESG strategy?
Yeah, I mean, I think there's definitely a regulation around ESG and more compliance, more documentation. I mean, I think what is great about being housed within BlackRock is that we can really leverage all of the resources that BlackRock has to offer, and we have these scale advantages of the broader platform, and we can spread those costs amongst many different teams. And so I think it is, a barrier to scale for perhaps some of the smaller ESG funds who have to do that on their own without being able to kind of share the costs across the platform.
Okay. Just a thought to the upcoming elections in the US next year. If say Trump were to get in, I mean, I know BlackRock have received a bit of flack in the market about their sort of ESG policy and stance from certain parts of the Republican Party. Is that one of the big risks you may have coming up? People giving that thought within BlackRock as to whether that would mean some kind of change in your strategy, or might you be forced to reconsider?
I think it's really hard to say at the moment. One, does Trump actually get reelected? And then two, what are his policies once he gets reelected? I mean, I think we're already facing, as you mentioned, some pushback from Republican red states, and we are currently working through those obstacles. I mean, our goal really here is to offer a product that consumers and investors want. And so we're not forcing anyone to invest in this product. If someone is in the red state and they don't want to invest in this, they don't have to invest in it. But we do think we offer a very valuable investment opportunity for those who are looking for those traits that I mentioned: value, quality, income, and sustainability, kind of all bundled in one.
Okay, thank you. Stephen, they're just asking here, would a 10 to 15% decline in US indices allow you to go geared? It's looking likely as soft landing scenario evaporates. Any thoughts on that?
Yeah, I mean, there's no hard and fast rule about, how much US indices decline. So we really have to see what is happening in the markets. I mean, the reason why we're currently not geared is because we are apprehensive about the economic environment, and we will constantly assess and reassess the situation. And when we feel like valuations are at a more attractive level, and when we feel like perhaps the recession is more priced into the stock market, then we can deploy gearing as we kind of see fit.
Okay, so we know when you've started to gear up that maybe we're on the turn.
Yeah.
One to watch.
Right.
Okay, thank you, Lisa. We seem to be out of questions, unless anybody's got any final opportunity now to ask one more. Doesn't look like anybody's typing. No. Okay. Well, Lisa and Charles. Charles, I should have introduced you, I suppose. I didn't, but Charles, you're based for BlackRock in the UK. I think responsible for all product marketing. Would that be?
Yeah, broadly there, specifically covering our investment trusts. So we've got a range of 9 investment trusts, and as we were discussing earlier, Mike, we've got a bit of a mini BlackRock week. So tomorrow we've got BlackRock Greater Europe Investment Trust, and on Thursday the BlackRock Latin American investment trust. So
Right.
delighted to be able to join you and answer any questions.
Yes, around the world in a BlackRock week almost. So that's
Yeah.
a useful look at what's happening in all the markets, courtesy of BlackRock. Stephen's just said, thank you, helpful to understand the trust. Okay, so just a thank you. Thank you, Stephen. And thanks everybody for joining us. And thank you, Lisa and Charles, for sharing with us the latest news on the trust today. So look forward to seeing you again soon. So some sooner than others.
Great.
Fantastic.
Thank you
Thank
so
you,
much.
Mike. Yeah.
All right. Thanks. Bye for now.